Hello and welcome to today's episode, which deal with India's balance of payment, including invisibles. Factors affecting balance of payment, measures to improve balance of payment position. Students, today we will understand the topic India's balance of payments, including invisibles, factors affecting balance of payment, measures to improve balance of payment position, and cover concepts related to it. Definition of balance of payment. According to the RBI, balance of payment is a statistical statement that shows the transaction in goods, services, and income between an economy and rest of the world. Definition. According to the RBI, balance of payment is a statistical statement that shows, first, the transaction in goods, services, and income between an economy and the rest of the world. Second, changes of ownership and other changes in that economy's monetary gold, specially drawing rights and financial claims on and liabilities to rest of the world. And third, unrequited transfers. Description. The transaction in balance of payments are categorized in A. Current account showing export and imports of visibles, also called merchandise, and invisibles, also called non-merchandise. Invisibles take into account services, transfers, and income. B. Capital account showing a capital expenditure and income for a country. It gives a summary of the net flow of both private and public investments into an economy. External commercial borrowing, foreign direct investments, foreign portfolio investments, etc. form a part of capital account. C. Errors and omissions. Sometimes the balance of payment does not balance. This imbalance is shown in the balance of payments as errors and omissions. Balance of payment is complied using the double entry book keeping systems consistent assets and liability. The balance of payments, also known as balance of international payments and abbreviated BOP, of a country is the record of all economic transactions between the residents of the country and rest of the world in a particular period, over a quarter of a year or more commonly over a year. These transactions are made by individuals, firms, and government bodies. Thus, the balance of payments includes all external visible and non-visible transactions of a country. It represents a summation of country's current demand and supply of the claims of foreign currencies and of foreign claims on its currency. These transactions include payments for the country's exports and imports of goods, services, financial capital, and financial transfers. It is prepared in a single currency, typically the domestic currency for the country concerned. Sources of the funds for a nation, such as exports or the receipts of the loans and investments, are recorded as positive or surplus items. Uses of funds, such as for imports or invest in foreign countries, are recorded as negative or deficit items. When all components of the BOP accounts are included, they must sum to zero with no overall surplus or deficit. For example, if a country is importing more than it exports, its trade balance will be in deficit, but the shortfall will have to be counterbalanced in other ways, such as by funds earned from its foreign investments, by running down central bank reserves, or by receiving loans from other countries. While the overall BOP accounts will always balance when all types of payments are included, imbalances are possible on individual elements of the BOP, such as the current account, the capital account excluding the central bank's reserves account, or the sum of the two. Imbalances in the later sum can result in surplus countries accumulating wealth, while deficit nations becoming increasingly indebted. The term balance of payments often refers to this sum. A country's balance of payments is said to be in surplus. Equivalently, the balance of payments is positive by a specific amount if sources of funds such as export goods sold and bonds sold exceed uses of funds such as paying for imported goods and paying for foreign bonds purchased by that amount. There is said to be a balance of payments deficit. The balance of payments is said to be negative if the former are less than the later. A BOP surplus or deficit is accompanied by an accumulation of foreign exchange reserves by the central bank. Under a fixed exchange rate system, the central bank accommodates those flows by buying up any net inflow of funds into the country or by providing foreign currency funds to the foreign exchange market to match any international outflow of funds, thus preventing the funds flow from affecting the exchange rate between the country's currency and other currencies. Then the net change per year in the central bank's foreign exchange reserves is sometimes called the balance of payments surplus or deficit. Alternatives to a fixed exchange rate system include a managed float where some changes of exchange rates are allowed, or at the other extreme a purely floating exchange rate, also known as purely flexible exchange rate. With a pure float, the central bank does not intervene at all to protect or devalue its currency, allowing the rate to be set by the market, and the central bank's foreign exchange reserves do not change, and the balance of payment is always zero. Components. The current account shows the net amount a country is earning if it is in surplus or spending if it is in deficit. It is the sum of balance of trade, net earning on export minus payments for imports, factors income earning on foreign investments minus payments made to foreign investors, and cash transfers. It is called the current account as it covers transactions in here and now, those that don't give rise to future claims. The capital account records the net change in ownership of foreign assets. It includes the reserve account, the foreign exchange market operations of a nation's central bank, along with loans and investments between the country and the rest of the world, but not the future interest, payments and dividends that the loans and investments yield. Those are earnings and will be recorded in the current account. If a country purchases more foreign assets for cash than the assets it sells for cash to other countries, the capital account is said to be negative or in deficit. The term capital account is also used in the narrower sense that excludes central bank foreign exchange market operations. Sometimes the reserve account is classified as below the line and so not reported as part of the capital account. Expressed with the broader meaning for the capital account, the BOP identifier states that any current account surplus will be balanced by a capital account deficit of equal size, or alternatively, a current account deficit will be balanced by a corresponding capital account surplus. The balancing item, which may be positive or negative, is simply an amount that accounts for any statistical error and assures that the current and capital accounts sum to zero. By the principles of double entry accounting an entry in the current account gives rise to an entry in the capital account and it aggregates the two accounts automatically balance. A balance isn't always reflected in reported figures for the current and capital accounts, which might, for example, report a surplus for both accounts, but when this happens, it always means something has been missed. Most commonly, the operations of the country's central bank and what has been missed is recorded in the statistical discrepancy terms, the balancing item. An actual balance sheet will typically have numerous subheadings under the principal divisions. For example, entries under current account might include first, trade buying and selling of goods and services, exports a credit entry, imports a debit entry. Trade balance, the sum of exports and imports. Second, factors income, repayments and dividends from loans and investments. Factor earnings, a credit entry. Factor payments, a debit entry. Factor income balance, the sum of earnings and payments. Especially in older balance sheets, a common division was between visible and invisible entries. Visible trade recorded imports and exports of physical goods. Entries for trade in physical goods excluding services is now often called the merchandise balance. Invisible trade would record international buying and selling of services and sometimes would be grouped with transfer and factor income as invisible earnings. The term balance of payment surplus or deficit, the deficit is simply a negative surplus, refers to the sum of the surpluses in the current account and the narrowly defined capital account, excluding changes in the central bank reserves. Economic writer J. Orlin Grabe warns the term balance of payments can be a source of misunderstanding due to divergent expectations about what the term denotes. Grabe says the term is sometimes misused by people who aren't aware of the accepted meaning, not only in general conversation but in financial publications and the economic literature. A common source of confusion arises from whether or not the reserve account entry, part of the capital account, is included in the BOP account. The reserve account records the activity of the nation's central bank. If it is excluded, the BOP can be in surplus, which implies the central bank is building up foreign exchange reserves, or in deficit, which implies the central bank is running down its reserves or borrowing from abroad. The term balance of payment is sometimes misused by non-economists to mean just relatively narrow parts of the balance of payments. BOP such as the trade deficit, which means excluding part of the current account and the entire capital account. Another cause of confusion is the different naming conventions in use. Before 1973, there was no standard way to break down the BOP sheet, with the separation into invisible and visible payments sometimes being the principal division. The IMF have their own standards for balance of payments. BOP accounting, which is equivalent to the standard definition but uses different nomenclature, in particularly with respect to the meaning given to the term capital account. The IMF definition of balance of payment. The International Monetary Fund use a particular set of definition for the balance of payments, BOP accounts, which is also used by the Organization for Economic Cooperation and Development and the United Nations system of national accounts. The main difference in the IMF's terminology is that it uses the term financial account to capture transactions that would under alternative definitions be recorded in the capital account. The International Monetary Fund uses the term capital account to designate a subset of transactions that, according to other usage, form a small part of the overall capital account. The International Monetary Fund separates these transactions out to form an additional top level subdivision of the balance of payment accounts. The International Monetary Fund uses the term current account with the same meaning as that used by other organizations, although it has its own name for its three leading subdivisions, which are: first, the goods and services accounts, the overall trade balance; second, the primary income account, factor income such as from loans and investments; third, the secondary income account, transfer payments. Balance of payments are also known as balance of international trade. Imbalances. While the balance of payments BOP has to balance overall surpluses or deficits on its individual elements, can lead to imbalances between countries. In general, there is concern over deficit in the current account. Countries with deficit in their current account will build up increasing debt and or see increased foreign ownership of their assets. The types of deficits that typically raise concern are: a visible trade deficit, where a nation is importing more physical goods than it exports, even if this balance by the other components of the current account. Next, an overall current account deficit. Next, a basic deficit, which is current account plus foreign direct investment, but exchange other elements of the capital account like short-term loans and the reserve account. As discussed in the history section below the Washington Consensus, period saw a swing of opinion towards the view that there is no need to worry about imbalances. Opinion swung back in the opposite direction in the wake of financial crisis in 2007-2009. Mainstream opinion expressed by leading financial press and economics international bodies like the International Monetary Fund, as well as leaders of surplus and deficit countries, has returned to the view that large current account imbalance do matter. Some economists do, however, remain relatively unconcerned about imbalances, and there have been assertions such as Michael P. Dooley, David Flockter-Ladue, and Peter Gaber that nations need to avoid temptation to switch to protectionism as means to correct imbalances. There are conflicting views as to primary cause of BOP imbalances, with much attention on the US, which currently has by far the biggest deficit. The conventional view is that current accounts factors are the primary cause. These include the exchange rate, the government's fiscal deficit, businesses, competitiveness, and private behavior such as willingness of the consumer to go into debt to finance extra consumption. An alternative view argued at length in 2005 paper by B.B.S. is that primary driver is the capital account, where a global saving glut caused by savers in surplus countries runs ahead of the available investments opportunities and is pushed into the US, resulting in excess consumption and excess price inflation. In the context of BOP and international monetary system, the reserve asset is the currency or other store of value that is primarily used by nations for their foreign reserves. BOP imbalances tend to manifest as hordes of the reserve assets being amassed by surplus countries, with deficit countries building debts denominated in the reserve asset or at least depleting their supply. Under a gold standard, the reserve asset for all members of the standard is gold. In the Bretton Woods system, either gold or the US dollar could serve as the reserve asset, though its smooth operation depended on countries apart from US choosing to keep most of their holdings in dollars. Balance of payment crisis. A balance of payment crisis, also called currency crisis, occurs when a nation is unable to pay for essential imports and or service its debt repayments. Typically, this is accompanied by a rapid decline in the value of the affected nation's currency. Crises are generally preceded by large capital inflows, which are associated at first with rapid economic growth. However, a point is reached where overseas investors become concerned about the level of debt their inbound capital is generating and decide to pull out their funds. The resulting outbound capital flows are associated with a rapid drop in the value of the affected nation's currency. This causes issues for firms of the affected nations who have received the inbound investments and loans, as the revenue of those firms is typically most derived domestically, but their debts are often dominated in a reserve currency. Once the nation's government has exhausted its foreign reserves, trying to support the value of the domestic currency, its policy options are very limited. It can raise its interest rates to try to prevent further declines in the value of its currency, but while this helps those debts denominated in foreign currency, it generally further depresses the local economy. Balancing mechanism. One of the three fundamental functions of an international monetary system is to provide mechanisms to correct imbalances. Broadly speaking, there are three possible methods to correct BOP imbalances, though in practice a mixture including some degree of at least the first two methods tend to be used. These methods are adjustments of exchange rates, adjustments of nations' internal prices along with its level of demand, and rule-based adjustments. Improving productivity and hence competitiveness can also help, as can increasing the desirability of exports through other means, though it is generally assumed a nation is always trying to develop and sell its products to the best of its abilities. Rebalancing by changing the exchange rate. An upward shift in the value of nation's currency relative to others will make a nation's export less competitive and make imports cheaper, and so will tend to correct a current account surplus. It also tends to make investments flows into the capital account less attractive, so will help with a surplus there too. Conversely, a downward shift in the value of a nation's currency makes it more expensive for its citizens to buy imports and increases the competitiveness of their exports, thus helping to correct a deficit, though the solution often doesn't have a positive impact immediately due to the Marshall-Lennox condition. Exchange rates can be adjusted by government in rules-based or managed currency regimes and left to float freely in markets. They also tend to change in the direction that will restore balance. When a country is selling more than it imports, the demand for its currency will tend to increase as other countries ultimately need the selling country's currency to make payments for the exporters. The extra demand tends to cause a rise of the currency's price relative to the others. When a country is importing more than it exports, the supply of its own currency on the international market tends to increase as it tries to exchange it for foreign currency to pay for its imports, and this extra supply tends to cause the price to fall. BOP effects are not the only market influence on exchange rates. However, they are also influenced by differences in national interest rates and by speculation. Rebalancing by adjusting internal price and demand. When exchange rates are fixed by a rigid gold standard, or when imbalances exist between members of a currency union such as Eurozone, the standard approach to correct imbalances is by making changes to the domestic economy. To a large degree, the change is optional for the surplus country, but compulsory for the deficit country. In the case of a gold standard, the mechanism is largely automatic. When a country has a favorable trade balance, as a consequence of selling more than it buys, it will experience a net inflow of gold. The natural effect of this will be to increase the money supply, which leads to inflation and an increase in price, which then tends to make its goods less competitive and so will decrease its trade surplus. However, the nation has the option of taking the gold out of the economy, thus building up a hoard of gold and retaining its favorable balance of payment. On the other hand, if a country has an adverse BOP, it will experience a net loss of gold, which will automatically have a deflationary effect unless it chooses to leave the gold standard. Prices will be reduced, making its export more competitive and thus correcting the imbalance. A possible method for surplus countries such as Germany to contribute to rebalancing efforts when exchange rate adjustments is not suitable is to increase its level of internal demand. While a current account surplus is commonly understood as the excess of earnings over spending, an alternative expression is that it is excess of saving over investments. If a nation is earning more than it spends, the net effect will be to build up saving, except to the extent that those savings are being used for investments. If consumers can be encouraged to spend more instead of saving, or if the government runs a fiscal deficit to offset private savings, or if the corporate sector divert more of their profits to invest, then any current account surplus will tend to be reduced. Rules-based rebalancing mechanisms. Nations can agree to fix their exchange rates against each other and then correct any imbalances that arise by rules-based and negotiated exchange rate changes and other methods. The Bretton Woods system of fixed but adjustable exchange rates was an example of a rule-based system. John Maynard Keynes, one of the architects of the Bretton Woods system, had wanted additional rules to encourage surplus countries to share the burden of the rebalancing, as argued that they were in a stronger positions to do so, as he regarded their surpluses as negative externalities imposes on the global economy. Keynes suggested that traditional balancing mechanism should be supplemented by the threat of confiscation of a portion of excessive revenue if the surplus country did not choose to spend it on additional imports. However, his ideas were not accepted by the Americans at that time. In 2008-2009, American economist Paul Davidson has been promoting his revamped from the Keynes plan as a possible solution to global imbalances, which in his opinion would expand growth all round without the domestic risk of other rebalancing methods. Students, we have covered India's balance of payments including invisibles, factors affecting balance of payments, measures to improve balance of payments position. That is all for today. Hope you have understood. We'll see you again with the next topic. Till then, take care. Bye.